Well, folks, buckle up. We're diving deep this week into some pretty choppy waters.
Yeah.
The U.S. stock market took a real tumble between March 31st and April 4th.
It did?
And we're talking a notable hit across the board: Dow Jones,
Mm-hmm.
S&P 500,
Yeah.
Nasdaq, you name it.
All the big ones.
Yeah, all the big ones took a hit.
Yeah, it started with like this little spark of optimism, right? Everyone's eyes on those trade and tariff negotiations, hoping for some good news.
Right, like a ceasefire.
Exactly, a ceasefire.
Mhm.
But by the end of the week, total sell-off across the board. Investors went from like cautiously hopeful to just plain worried.
That shift, that's what we're dissecting today.
Absolutely.
We want to understand what really drove this volatility, how different sectors reacted, did any weather the storm, and most importantly, what does all this mean for you? You know, as you think about your own financial decisions,
For sure.
we've got a comprehensive weekly market report packed with data, so
Let's break it down.
let's break it down.
All right, so picture this. The week kicks off with a touch of, dare I say, positivity. Tuesday rolls around, modest gains in the Dow and S&P 500, the Nasdaq. That actually rallied, like
Yeah.
a full 1% jump.
It's a little glimmer of a comeback, a sigh of relief.
Yeah, you could feel it. Like the market was pausing for a breather, but
It's a short breather.
very short. By Friday, the mood had completely tanked.
Yeah, the market did not hold on to those gains. Can you quantify the damage? How bad were those losses by the end of the week?
Okay, so by Friday's closing bell, the Dow Jones Industrial Average down a solid 5.5%. The S&P 500, trailing close behind, down 5.97%.
Ooh, those are some serious numbers.
But get this, for the S&P 500, that was its second month in a row of decline.
Ouch.
Year-to-date loss, about 8.2%.
That stings.
Yeah, no kidding. And the tech sector, remember all that talk about how tech was invincible?
Right, like they were immune to gravity.
Exactly.
That-
Well, guess what? The Nasdaq Composite down 5.82% for the week,
Wow.
bringing their year-to-date losses to over 10%.
So officially in bear market territory then.
Oh, yeah. 20% or more decline from a recent peak. That's a bear market, no doubt.
Yeah.
And a huge shift in momentum for the tech-heavy Nasdaq.
Massive. And didn't the fear gauge, the volatility index, didn't that spike too?
Oh, yeah, big time. The CBOE Volatility Index, the VIX, soared by over 50%, landing above 30.
So basically investors were expecting even more price swings, like bracing for impact.
Exactly. When that VIX jumps up, it means investors are anticipating bigger price swings in the near future.
Yeah.
So yeah, the fear was palpable. It was the market's worst week in a long while.
So let's unpack this. We had this initial cautious optimism, then a complete free fall. What were the major culprits? What drove that shift?
No question, the main driver was trade tensions. The whole sequence of events really threw the market for a loop.
Okay, walk me through it.
So early in the week, there was this hope, right, that maybe, just maybe, those trade tariffs would ease up.
Yeah, a little bit of wishful thinking.
Totally.
Yeah.
And that's what gave us that little bump on Tuesday. But then, boom, President Trump announces these new tariffs, calls it Liberation Day.
I remember that. And they went into effect pretty quickly, right?
No, April 2nd. But it didn't stop there.
Oh,
China hit back
hard.
hard, slapped a 34% tariff on U.S. imports.
Oof, that's a serious counterpunch.
Absolutely. And that, my friend, that's what really sparked that Thursday and Friday sell-off. Investors suddenly had to face the music, the very real possibility of a full-blown trade war.
Right, with all its potential consequences.
Yeah, it was a wake-up call.
So trade tensions were front and center. But I remember seeing some economic data that week that painted a bit of a different picture, right? Like some good news, some not so good news. Did that play a role?
Oh, absolutely. The economic data was a bit of a mixed bag. Midweek, we got the ADP employment report, and that was actually pretty strong. Showed 155,000 private sector jobs added in March.
So more people working.
More people working. And that beat economists' predictions by a decent margin.
So at first glance, that sounds good, right? Why didn't that calm the market down a bit?
It's a good question. And, you know, initially it did seem promising, but then later in the week, things took a turn.
Oh, what happened?
Friday rolled around, and we got the revised University of Michigan Consumer Sentiment Index. And it had plummeted to a 32-month low.
Wow, that's a steep drop.
It is. And what it tells us is that consumers were starting to feel pretty pessimistic about the economy, like less confident about the future.
Not a good sign.
Nope. And to add fuel to the fire, there was another piece of worrisome news. Inflation expectations. They were ticking up, reaching 5%.
So you've got declining consumer confidence, rising inflation worries. Didn't this raise some alarm bells about stagflation? Like the dreaded S word.
Oh, it did. That combination, slowing economic growth, high inflation, that's a nightmare scenario for everyone, from businesses to everyday consumers.
So you've got this conflicting economic picture, strong job growth, but weakening consumer sentiment and rising inflation fears.
Hmm.
How did the Fed react to all of this?
Well, the Fed had been holding steady on interest rates, right? But with that surprisingly strong job data, the market started to shift its expectations.
In what way?
People started pushing back their predictions for when the Fed might start cutting rates.
Yeah.
Like, the consensus shifted towards a possible rate cut in June instead of sooner.
So a delay in the hoped-for relief.
Exactly. And that had a couple of knock-on effects. First, it put downward pressure on those growth stocks, the ones that are really sensitive to changes in interest rates. And second, it just added to the overall market volatility.
Right, because investors had to readjust their strategies based on these shifting expectations.
Exactly. It was like one more thing to worry about.
So it sounds like the early week optimism was really hanging by a thread, hoping for some resolution on those trade disputes. And when that didn't materialize, when China responded with such force, it just spooked everyone, especially with those mixed economic signals adding to the anxiety.
Totally. It was a classic case of buy the rumor, sell the news. All that anticipation, all that hope for tariff relief, and then bam, reality hits, and it hits hard.
Yeah.
Suddenly, those trade disruptions, those potential economic consequences, they weren't just theoretical anymore. They were staring everyone right in the face.
Okay, so we've got the overall market picture, the key drivers behind the downturn. Now let's zoom in. How did different sectors of the economy fare during this volatile week? Did any manage to stay afloat?
Oh, absolutely. And, sector performance during this period, it was a perfect reflection of that overall risk-off sentiment we talked about. Like, investors were heading for the exits, running towards those safer assets.
Makes sense. So which sectors took the biggest hits? I'm guessing technology was pretty badly bruised.
Oh, yeah. Technology got hammered, down over 6% for the week.
Yikes. What were the main factors there?
Well, it was a combination of things. There were those heightened concerns about how tariffs would impact the tech industry, supply chains, manufacturing costs, all that.
Right. Those global supply chains are so intricate.
Exactly. And then there were those lingering worries about valuations. Some people were saying certain tech companies were just overvalued, and this was a correction waiting to happen.
A reality check, maybe.
Yeah, something like that. And those semiconductor stocks, they got hit particularly hard. And of course, all of this contributed to the Nasdaq, entering that bear market territory we discussed earlier.
Right, the 20% drop.
Exactly. So, yeah, tech definitely felt the pain.
Okay, what about consumer discretionary? That's usually a good indicator of how confident people are feeling about spending, right?
Absolutely. And consumer discretionary, well, they took a tumble too, about 5.5% down.
So people tightening their belts.
It seems so. It's interesting, though. The sector actually started the week on a slightly positive note. Travel and retail stocks saw some gains early on.
Huh, riding that wave of initial optimism.
Yeah, I think so.
Yeah.
But those gains evaporated fast.
What changed?
Two things, really. First, those tariff fears started to kick in. People worried about those costs getting passed down to consumers, higher prices at the checkout.
Makes sense.
And then that weaker than expected consumer sentiment data, that just sealed the deal.
Right. If people aren't feeling good about the future, they're less likely to splurge.
Exactly. Discretionary spending, that's the first thing to go.
So consumer discretionary down. What about industrials? They're also pretty closely tied to global trade, right?
Oh yeah, industrials are right in the thick of it. And they definitely felt the heat, down about 4.8% for the week.
Ouch. Was that all trade related?
Largely, yeah. The big concern was those disruptions to global supply chains, the potential for delays, higher costs, all that mess. And even though that ADP report showed some positive signs in manufacturing, it wasn't enough to offset the broader worries about trade policy.
So even some bright spots couldn't outweigh the gloom.
Yep. When trade uncertainty is looming, it's hard to ignore.
Okay, one last sector. Financials. They had been showing some resilience earlier in the year, hadn't they?
Yeah, they had.
Yeah.
And actually, they started this week off with some decent momentum, too.
Really? What was driving that?
Well, partly it was those expectations of higher interest rates. Banks tend to benefit when rates go up.
Right. Makes their loans more profitable.
Exactly. But then, as the week went on, those recession fears started to creep in.
Spoiling the party.
Yeah, big time. And those higher rate expectations, they faded fast. So even though we had those positive employment figures, financials ended the week down about 4%.
Wow. So a roller coaster ride for them, too?
Definitely. It just goes to show how quickly sentiment can shift when those big macroeconomic fears enter the picture.
So it sounds like the sectors focused on growth, especially those heavily involved in global trade, they bore the brunt of this downturn. Were there any sectors that weathered the storm? Any safe havens?
Oh, there were a few.
Yeah.
We saw some relative outperformance, especially in those defensive sectors, the ones that are less sensitive to economic swings.
Give me an example.
Consumer staples, for example. They were down, but only by about 2%.
So people still got to eat, right?
Exactly. Those are the companies that provide the essentials, the things people buy no matter what the economy's doing. They tend to be more resilient when times get tough.
Makes sense. Any other bright spot?
Believe it or not, energy actually ended the week up.
Really? Up in this market?
Yep, about 1% up.
Wow, that is surprising. What drove that?
Primarily, it was those rising oil prices. And that was partly due to increased imports of Canadian crude oil.
Ahead of the tariffs.
Exactly. So in this case, those sector-specific factors and how those tariffs impacted that one commodity, they actually insulated energy stocks from the broader market turmoil.
Huh. So sometimes it's about being in the right place at the right time, I guess.
Sometimes, yeah. It shows you how complex these market dynamics can be.
It's fascinating to see how these big market trends play out at the individual stock level. Were there any specific companies that really stood out? Either for doing particularly well or particularly badly?
Oh, absolutely. There were a handful of companies that really captured the essence of what was happening in the market that week.
Give me an example. What about Tesla? They've been in the news quite a bit lately.
Yeah, Tesla had a rough week, down over 8%, which actually added to their already substantial losses for the year. They had a little bump early on, riding that wave of initial optimism, but then it was all downhill from there.
What were the main concerns for Tesla?
Well, there are worries about slowing sales and also that potential for higher trade costs. With those tariffs in place, those imported parts get more expensive.
Right, so that eats into their margins.
Exactly. It's a tough spot to be in.
Okay, what about in the tech space? You mentioned NVIDIA earlier. How did they fare?
NVIDIA, they're a major player in semiconductors, right?
Mhm.
And they took a significant hit, about 7% down. Their decline really accelerated towards the end of the week as the whole tech sector felt the fallout from those tariffs. They were a big contributor to the Nasdaq's overall losses.
So a tough week for tech giants.
Yeah, no kidding. But it wasn't all doom and gloom for every single stock. There were a few outliers.
Like who?
HDFC Bank, for example. They actually saw a decent rise, about 3% in the middle of the week. They were part of that brief rally on Tuesday, remember?
Right, that little blip of optimism.
Exactly. But even they couldn't escape the broader market forces. By Friday, they had succumbed to the prevailing negative sentiment.
So even a brief moment in the sun.
Yeah, but it was short-lived. No one was immune to those big picture worries.
And what about a more traditionally safe stock? Like Johnson & Johnson, how did they hold up?
J&J, they declined, but only by about 2%. It was part of a more general weakness in the healthcare sector that week, maybe due to some regulatory developments. But compared to those steep drops in tech, J&J was practically a rock.
A beacon of stability.
Yeah, exactly.
Totally.
It just goes to show that when uncertainty reigns, investors flock to those established, reliable companies. They're looking for safety.
Right, a port in a storm.
Exactly.
Okay, so we've covered the stock market, but what about other assets, like bonds and commodities? Did they react to this volatility too?
Oh, absolutely. Those markets were definitely not immune. And the bond market, it was a textbook case of flight to safety.
Okay, what does that look like in practice?
Well, we saw a decrease in U.S. Treasury yields. Like the 10-year Treasury yield, which is a key benchmark, it fell from 4.2% to 4.13% by the end of the week.
So people were piling into bonds.
Exactly. They
Yeah.
were looking for a safe haven. And this happened even with those persistent signals of inflation we talked about earlier, which is interesting.
Why is that interesting?
Well, usually when inflation is a concern, investors shy away from bonds because inflation erodes their returns. But in this case, those fears about volatility, about a potential slowdown, they trumped those inflation concerns. Investors were willing to accept lower returns in exchange for safety.
So a real aversion to risk. What about commodities? They can sometimes act as a hedge, right? Like a way to protect against economic turmoil.
They can, but this time we saw a bit of a mixed bag. Oil, specifically West Texas Intermediate crude, it actually rose about 1%, reaching around $70 per barrel.
Huh, interesting. Why was that?
Well, part of it was that increase in Canadian crude oil imports we talked about earlier, in anticipation of those tariffs.
Right, so stock up before the prices go up.
Exactly. But there was also this underlying concern about global demand. Like, if this trade war escalated and the economy slowed down, that could hurt demand for oil. So that tempered those gains a bit.
So a bit of a tug of war there.
Definitely.
Okay,
Yeah.
what about gold? That's the classic safe haven asset, right? Did it shine during all this market turbulence?
Gold did hold its value, yeah. It stayed near that $3,000 per ounce level, even showed a slight increase for the week.
So still a haven in a storm.
For sure. But it's worth noting that it didn't surge dramatically, like it has in some past periods of intense market stress.
So a more muted response this time around?
Yeah, I'd say so. Maybe investors weren't quite as panicked as they've been in the past.
Okay, so we've looked at the U.S. market, but these events don't happen in a vacuum, right? How did the rest of the world react to this week of turmoil?
We'll put it this way. The U.S. market sneezed, and the rest of the world caught a cold.
No, that's a good analogy.
Yeah, those U.S. declines. They sent ripples across global financial markets.
Okay, give me some specifics. What happened in Europe and Asia?
Europe saw declines, generally in the 2–3% range. They were definitely feeling the anxieties around those trade tensions and also that weaker investor sentiment coming from the U.S. It's worth noting, though, that European markets had actually been outperforming the U.S. earlier in the year, so they may have had a bit of a cushion.
A little bit of resilience built up.
Yeah, something like that.
Okay, what about Asia? They're so tied to global trade, it must have hit them pretty hard.
Oh, it did. Asia saw some sharp drops. Those retaliatory tariffs from China, they really rattled sentiment in the region. Japan's Nikkei and Hong Kong's Hang Seng, both down over 2%, a direct reflection of that escalating trade war.
Ouch. So a domino effect.
Exactly. And it wasn't just the developed markets that were feeling the pain. Emerging markets were facing serious concerns, too.
I imagine so. They're often more vulnerable to these global shifts, aren't they?
They are. There were worries about currency depreciations, their currencies losing value, and also about potential credit deterioration. Like, would they be able to repay their debts if things got really bad? With those tariff levies reaching levels not seen in almost a century, it put a lot of pressure on those export-oriented emerging economies.
So a real ripple effect across the globe.
Absolutely. It was a stark reminder of just how interconnected the global financial system is. What happens in the U.S. doesn't stay in the U.S., that's for sure.
Okay, so to sum it all up, a turbulent week dominated by escalating trade tensions, which really overshadowed any positive glimmers from the economic data. We saw widespread declines across most major asset classes, and investors definitely shifted into a more risk-averse mode.
That's a perfect summary. All that initial optimism at the start of the week, it just vanished as the potential for those trade conflicts and their economic consequences became more real. That's what sparked that sell-off and that flight to safety we saw in bonds.
So, for everyone listening, the takeaway here is clear. Market sentiment can shift on a dime, especially when you've got geopolitical events like those trade policy announcements in the mix. And that brings me to a question for all of you. Considering how quickly things can change based on these trade developments, what fundamental economic indicators do you think will be the most resilient in the weeks and months ahead? What will help us weather the storm? Think about it. Macroeconomic data, corporate earnings, geopolitical events, how do they all interact? Thanks for joining us for this deep dive, and keep those questions coming.